Hello, it's Mike Williams, Genesis, and thanks for joining us here on this video update. It's sort of a review of the review we sent out in early summer, just as Q2 was ending, and we prepped everyone for what we had hoped would be a summer swoon. Our summer began with a prayer. It was simple. Pray for a setback, and then take advantage of it. We stated several things in our Q2 review. The trade range had been in effect for months. We expected more of the same. We suggested this summer would be much like most summers. Choppy, boring, and volatile. As much as we did not like it either, we stated very clearly a wave of setbacks would be a good thing, something long-term investors should consider a gift. We repeated that the crowd was likely to run for the hills, and run quickly, waiting for later to ask any questions, as fears from 2008 and 2009 would quickly rise to the surface. Finally, we stated the ideal time for this to unfold would be in the later days of August. Why the later days of August? Simple. No one would be watching. Most would be away. Fewer would be paying attention. Volume would permit prices to become disconnected. And then price action began to break down, just as we hit the latter half of August. And the crowd? Well, just as anticipated, they did what their emotions triggered. They sold as the pain of 2009 was reborn, with a vengeance. How much did they panic? According to BAML, that's Bank of America Merrill Lynch, data just released, they panicked in record amounts. And here's the picture of it. That dotted line connects this latest week, fresh in our minds, with the week back in 2008 when Lehman collapsed and the crisis was on. Now think about that for a second. They sold record amounts of equity funds this week, more than at any other time, all the way back to 2008. Calling it, quote, total risk surrender and capitulation, BAML says $29.5 billion was taken out of stock funds in the week ended Wednesday, a record since the numbers began being kept in 2002. Now think about that for a second. There have been two major bottoms in the stock market. 2003 for the tech bubble, 2009 for the crisis that collapsed the world financial system. And interestingly enough, this past week, they sold more than either of those panics. They went on to state, quote, the action on Tuesday was especially stunning. An outflow of $19 billion on one day, the most since the global financial crisis, and for now, coinciding with the exact bottom of the current move. So let's take a deep breath. Focus on the big picture. Count to 1,477,206, or to whatever number causes you to relax. And let's go back to review the review. This was the view provided for the long-term trade range at work in the markets as summer began. You'll remember the blue box and the red box. The red box was defined for you as the larger trade range going all the way back to last summer. The blue box helped you to define the tighter trade range, which had, until that time, controlled prices since November of last year for nearly 7 months. Now, we focused in on the smaller trade range first, and we suggested, quote, often you will see previous lows taken out by just a tad to wipe out stops accumulated by traders. Now, I've noted that for you in these two blue circles. And remember in an earlier update, that first blue circle was 204.12 on the S&P 500 Spider. The low on that second blue circle was 204.11, just enough to take out the stops. And then we bounced right back up into that blue trade range. After those stops had been taken out, we then focused in on the idea that a retest was highly likely, quote, given the worst parts of August lie ahead. And now you'll notice that red circle on this screen. That red circle shows you that price came back down to the lower end of that blue box, that tighter range, and literally skipped over it. You'll see that there is a gap in the chart and the panic was on. As you can see here in price action, the market first gapped over all those stops at the bottom of the smaller trade range, and the very next day, it gapped over all the stops at the bottom of the larger trade range. A larger view provides clarity. The panic was indeed unfolding. Now notice that it all took place in about 3 days. So that one long day, I'm going to talk a little bit more about that Monday activity in another couple of screens, but I just want to piece this together for you so it can make some logical sense to you and you can see there's actually a method to the madness, if you will. And right on cue, the selling ensued. Stops were triggered and emotions exploded. And here on this screen, I'm showing you again how equity outflows gave you a sense of just how quickly the panic ensued. That burst of panic brought prices all the way back to October 14 lows, as seen here. Note the dotted blue line on this chart. It took prices all the way back to that 11-day correction we had back in October of 2014. So again, I'm piecing this logic together for you so you can begin to see what happens. Now, interestingly enough, notice that in a matter of 72 hours, less than 18 trading hours later of open trading sessions, the market had bounced right back in to that larger trade range we had pointed out for months in other videos. So that's a good sign, but let's continue to try to focus in on how this has unfolded so you don't fear it. Most important than several of these items brought together right now is this. The trade range of this last week alone is equal to the trade range of the entire last 13 months, marked out by that red box. Again, these are all the same things you've seen in previous videos. This time around, I've added these two orange boxes. That orange box farther to the right of your screen is the price action of the last week. And you'll notice I drew that box from the bottom of the trade range in red all the way to the bottom of the price action on Monday. That exact range has been given to you in a second orange box back to the left of the screen. And what you'll find is they're equal to the entire trade range marked in red. Literally equal. So I find that fascinating that in 13 months we had market action that kept ourselves in a trade range. And in literally one day, from previous day's close to the low of the next day, that being Monday, after the Friday panic began, literally covered the same price range, all in a 6-hour period, and then bounced right back up. Let's step back and recognize something else we can take data from: volume. Once again, I've shown you the far back screen so you can see a couple years of price action. You can see that trade range for what it is. You can see the tighter trade range in blue. You can see the gap down below it where all the stops were taken out and the panic unfolded. All the equity funds set records of outflows. People rang the phone all day long. In fact, there are some organizations that don't even have their prices from Monday yet because they are behind with orders. Now, I've added one smaller, interesting set of data to the bottom of this chart, which shows volume. Notice that red dotted line. I drew that across the top of the volume on Monday. And I want you to notice that it is the highest day on all of this data. It is higher than the October panic by far, by almost 35% higher. And indeed, the two following days were higher still. So in that 3-day period, every single day exceeded the amount of volume we felt when we panicked the last time. We call it the footprints of fear. I've highlighted several tiers of volume levels. And what I want you to do is recognize that each tier shows that the peaks of those volume levels that hit those tiers, those previous highs, each one of those peaks were lows in prices as panic dissipates in a selling crescendo. Look at the red line. Obviously, there's only one bar that hits that, and that's Monday's action. By the way, that was the low. Let's go down to the blue horizontal bar, and you'll see that hits a couple. Each of those were lows. And then finally, the third tier, lower tier, the purple horizontal bar, that hits a couple other areas, and those were lows as well. When I say lows, I mean price lows. So what does that tell us? It tells us that as the noise and the panic hits a crescendo, you can fairly much count on the idea that you're coming into zones where buying is far more valuable than selling. Keep in mind, this assumes you have a long-term picture in mind and you have created a proper financial plan by which you keep track of it and follow it and stay disciplined. The point of this? The opportunity is in the fear. I note here the record levels hit last week. So now what? Ideally, we'd like to see this market stay down for a bit, though we must remember secular bull markets always surprise to the upside. Sentiment is now terrible. History tells us terrible sentiment equals the best deals. But more important, a few facts are in order about the supposed triggers of the summer panic, meltdown, plunge, swoon, or whatever word makes you feel the best. The China syndrome, the oil crush, the commodity collapse. We've stated for years, while most fretted over inflation, we suggested deflation should be the focus. Oddly enough, crushed commodities are a good thing for launching new growth waves. But now that we're all speaking of deflation, we suspect that odds are high we're witnessing a washout of the commodity lows, meaning a bottoming process will be next. And the good news? Inflation will indeed show itself again, just as everyone now fears deflation. That is why bonds did not go up this week as stock investors panicked. The lesson? Same old fears, same old crimes. We haven't changed since ancient times. I have to give my buddy Mark Knopfler credit for that from Dire Straits. It's a line straight out of Iron Hand. Great song. Points of importance? First, China. They will stabilize at lower growth rates, just like we've stated for many, many months. As exports to China are only 0.7% of our GDP, the health of the U.S. economy is not terribly dependent on the health of the Chinese economy. I know that sounds bizarre, but I want you to make note of that in your mind the next time the experts tell you to be afraid of a China slowdown. In fact, nearly everything unfolding in the fear category today is good news for the U.S. economy. Crazy, right? Lower commodity costs are good. Lower fuel costs are good. Pain in the oil belt? Good? You might be wondering. Yes, when it's over, we will create even more at better margins as technology improves and companies get more efficient through the pain. Slowdown in China? Good? Yes, because manufacturing comes back here as they struggle and their prices rise and our costs plummet. 10 years from now, oil will be a shadow of its former self, and most other sectors will have seen their margins explode as oil costs fall. In other words, the oil plunge does far more good than bad for the United States. Trust me on this. Were China not the current monster of fear today, and they were doing just fine, the press, the public, and the experts would all be bitching about other things. High commodity costs, high crude costs, peak oil, shrinking margins, terrible inflation, and be assured all of this, all of those elements, would be very bad for you too. So what now? Let's review the main chart snapshot again. Let's focus on the new blue box for a moment to set some framework to the insanity. Remember, we call these footprints of fear. This new blue box gives you a range of the collapse we've seen this week and the washout lows. Now, most of what we had outlined at the start of the summer has unfolded. In a perfect world, this box, which defines the price range of the panic, will now likely become a price range to test. What does that mean? Well, it means that we would like to see prices spend time meandering up and down the range of this price zone all by itself. The reasoning? You don't want to see this panic wasted. You want it to last for a bit, etching in a very strong platform of support from which to launch the next leg up. But before we get that, I have to admit one thing. I'd love to see a retest, and ideally, a washout of the lows, assuring the exit of any remaining weak hands. And when I say lows, I put a little orange and yellow star on the chart for you just to see what I meant. Now, in a perfect world, we'd come back down there and we'd dip right under it, just like we did in that blue trade range earlier in your charts, and take off again. Now, unfortunately, I have to admit, I fear we might not get that. So our very best deals in the panic may have already gone by. But let's use dips to continue to build. Crazy, right? Long-term investors should consider this a gift. Our economy just logged a 3.7% GDP growth rate in Q2. Our exports to China are 0.7% of that number. Our economy has massive tailwinds. They are being lost in the noise surrounding the fear. Remember, record amounts of selling. Now, I attest to you, you can go back into this data as long as you want, and here's what you're going to find. When the public panics out of their mutual funds, you are watching important, and I mean important for long periods of time, lows being made in prices. The idea, the panic, is indeed your benefit. Remember, bullish sentiment is sitting at numbers not seen since the 2009 global panic lows, thousands and thousands of points ago. I want you to realize that. 9,000 points ago, we felt as afraid as we do now. Does that sound logical to you? By the way, that red line is the S&P 500. Now, how big is the correction we're watching in the grand scheme of things? Not that big at all. The bottom line, prayers answered so far. The summer swoon of 2015 is on, and right on time. Now let's hope it sticks around for a bit as the summer haze wears off. Remember, there's still a week or two left before the real team comes back and starts playing the game. And remember this, the United States is in a unique position. The barbell economy is at work. Gen Y is coming, 100 million strong. Surprises remain to the upside. For more on Gen Y, make sure you click the link in the upper right-hand corner. And thanks again for your time on this video update. We sure hope it's added value to your day. Have a good one.